Let's come to financial reporting. And so in financial reporting, as always, we're going to be starting with some introductory discussions. So you must have knowledge on some key introductory discussions. Now, I'm calling it introductory discussion. It doesn't mean it is not in the syllabus. It's in the syllabus. You must know about it. So some introductory discussions. The introductory discussions here will include the following: the conceptual and regulatory framework. This will help you to have an understanding of elements of financial statement, measurement basis, qualitative characteristics of financial statement, various types of financial statement that the entity is preparing, and the objectives of the various financial statements. All of those things are captured under the conceptual framework and regulatory framework for the most part. Okay. Then certainly the concept of capital and capital maintenance. So that's the first thing we must understand in the introductory aspect. From there, we need to share some thoughts on the IFRS foundation. Okay, this is where we are looking at how accounting standards are set. Okay, the various IFRSs, IASs, how they are set. So what are the stages that we go through in setting standards? Generally, what are the processes that we go through? What are the roles of the International Audit and International Accounting Standard Board, then the advisory committee, then the various other bodies involved in the IFRS foundation in setting of the standards? What are their roles? We must know about this. It is part of our introductory discussions. It is important there. Number 3 is ethical issues. Yes, the professional accountant is required to behave in a manner that will be acceptable in the society. And so the fundamental code of conduct of integrity, objectivity, professional competence and due care, professional behavior, confidentiality is very important here. Then we must know about the threats to the code of conduct, which is self-interest threat, self-review threat, advocacy threat, familiarity threat, intimidation threat. So those ethical issues or ethical dilemma is part of the introductory issues that we need to understand. Then one thing you must also be mindful of is that now governance is taking, not a center stage, but governance is really key, and we need to understand corporate governance. All right. Very important. We need to understand corporate governance. So 2 key things we must be aware of here about corporate governance. What are the governance principles enshrined in the Companies Act 2019, Act 992, and then the governance principles. So you are going to be making reference to the Companies Act 2019, Act 992. Then also the corporate governance principles issued by the Security and Exchange Commission. You must know about them. So all of these are under the introductory issues. Why am I doing this? Because this is a 20 marks area that the examiner is going to be throwing at you in the exam hall. 20 marks. So although I am calling them introductory discussions, they are key issues that will be setting us up for the rest of the discussions when it comes to financial reporting. Once we are able to beautifully discuss these introductory issues, get all of them out of the way, 20 marks done and dusted, we now come to, the big aspect of the discussion, which is the IFRS masterclass. And so this is where you're going to be looking at the various accounting standards. And you must understand that when it comes to financial reporting, the accounting standards are the pillars that hold the entire subject. Why? Because we will have a 20-mark question on the accounting standards. Then we'll have number 3, single entity financial statement. If you are preparing statement of profit or loss and other comprehensive income, statement of changes in equity, statement of financial position, or the cash flow statement, all the footnotes there, we have to apply the accounting standards. And so we have 20 marks dedicated on the accounting standards. Then we have 20 marks applicable to the single entity financial statement preparation. Even when it comes to number 4, that is evaluation of financial statements, it's important you understand that the accounting standards are going to be chasing us down here depending on the context of the question. Why? Because sometimes the examiner can give us a set of financial statement with some footnotes, which will require us to then adjust the financial statement. The way we adjust the financial statement will depend on our understanding of the accounting standards, because we have to apply the accounting standards to the footnotes. Then we can do the necessary adjustment before we calculate the ratios and interpret it. Then the fifth thing, consolidated financial statement, that also you must have the accounting standards there, because some of the footnotes when it comes to consolidated financial statement, we will have the accounting standards there. And so the accounting standards then become what? Pivotal when it comes to the financial reporting examination. And this is also seen even in corporate reporting. The accounting standards plays a key role even in the corporate reporting examination. And so what are the accounting standards? We've gone through this before. I'm going to be bringing it up again. So we have the non-current asset standards. Please note, as I tell you always, it is important you understand that you understand what the examiner is going to be doing to you in the exam hall, the structure of the questions in the exam hall, so you can put yourself in the position to ultimately pass the examination. So the big question you ask yourself is, okay, when it comes to the accounting standards, what am I looking at? All right. Non-current asset accounting standards, whether you like it or not, there is going to be something about them, either dedicated specifically, or there will be a footnote that will require you to apply them. And this is where we are talking about IAS 16, property, plant, and equipment, IAS 23, borrowing costs, IAS 20, accounting for government grants and disclosure of government assistance, IFRS 5, non-current asset held for sale and discontinued operation, IAS 40, investment properties. So these are non-current asset accounting standards. Whether you like it or not, these 5 accounting standards, you will call on either 2 or 3 of them in every examination. Again, either as a dedicated question, or the principle will be applicable in dealing with something else that is another accounting standard or a certain footnote that you are applying. And so the non-current asset accounting standards, very important. You must understand them very well. But connected to these non-current asset accounting standards are other sets of accounting standards that you can see on the far right side, and that is IAS 37, provisions, contingent liabilities, and contingent assets. IAS 36, impairment of assets. IAS 38, intangible assets. IAS 12, income tax, very important. And then IAS 21, effect of changes in exchange rate. Now, for those of you writing, we are in financial reporting, right? So for financial reporting, whether you like it or not, you are guaranteed on IAS 16 and IAS 12, at least. So at least these 2 accounting standards is a done deal. It's waiting for you in the exam hall. Because whether I like it or not, you will deal with IAS 16. Whether I like it or not, you will deal with IAS 12. So these 2 accounting standards, you must know them. But you see, the beauty of the standards, as I mentioned, is that they are intertwined. So for instance, we could start the broader discussion with IAS 16, property, plant, and equipment. Now, when you take almost every accounting standard, one of the things you must understand is the issue in respect of key definitions. So when you pick most accounting standards, key definitions, okay? Because there are terms that we need to understand, terminologies that we need to understand when it comes to the accounting standards. Number 2, you must know the objectives of the accounting standards. Number 3, you must look at the initial measurement and recognition. Or before initial measurement and recognition, let me talk about initial recognition criteria, rather. So recognition criteria. Okay, then initial measurement and recognition. Okay, now you know the difference between measurement and recognition. Measurement is simply the monetary value at which a transaction is carried in the books. Recognition is simply the incorporation of a transaction into the financial statement of the entity. And so initial measurement and recognition. Next, you come to subsequent measurement. All right, subsequent measurement. Then the last thing is going to be disclosure requirements. So when it comes to the questions the examiner is going to be asking you, he can come from anywhere at all. At least the first two, we can ignore the first two a little bit, but the last four are crucial. So the examiner can come for you in recognition criteria. He can come for you on how something should be initially recognized. How would you know? Because the dates for the period that you are recognizing the item will be initial recognition. Or sometimes it has to be subsequent measurement. So you're going to do both initial recognition and subsequent measurement for the reporting date. Then the third thing is going to be disclosure requirement. So in respect of a certain accounting standard, what has to be disclosed in the financial statement or in the notes to the financial statement. So these four things are crucial. Almost every accounting standard you pick, you must ask yourself, what is the recognition criteria? For instance, when it comes to provisions, what's the recognition criteria? Okay, if it is rotten, you provide for it. So rot, meaning that the amount is reliably estimated, or there is a present obligation. T, transfer of future economic benefit embodying the entity, or the settlement of which will result into transfer of future economic benefit. All right. When it comes to assets, when do we recognize assets? We recognize assets if the cost can be reliably estimated and it is probable that the future economic benefit will flow to the entity. That's it. Right. So when you pick the standards, initial recognition criteria, initial measurement, subsequent measurement, disclosure requirement, every accounting standard you are learning, you must know these four things. Because the examiner can come for you in disclosure, which is reading theory aspect, or on subsequent measurement, which means you are going to be doing recognition and then the subsequent measurement in that regard. So when you pick something like IAS 16, property, plant and equipment, divided into two broad areas, we have the initial recognition and then subsequent measurement. Okay? Initial recognition and then subsequent measurement. Now, when it comes to initial recognition, what do we say? According to IAS 16, the initial cost of an asset shall be the purchases or the acquisition cost or construction costs, plus all other directly attributable costs incurred in bringing the asset to its present use. And so when you are dealing with IAS 16, on the initial recognition of property, plant, and equipment, there are certain accounting standards that may come to town depending on the context of the question. So what are these accounting standards? We will have IAS 37 provisions. Why? Because if there is an environmental cost that the entity will incur, or landscaping or dismantling costs that the entity will incur in the future, and there is a present obligation which is either legal or constructive, we have to discount that into present terms, and that present value should be included in the initial cost of the asset. So IAS 37 can come to town when we are dealing with initial recognition of an asset. Not only that, we can call on IAS 23 borrowing cost. Why? Because when an entity borrows funds to finance the acquisition or construction of a qualifying asset, then the borrowing cost must be included in the initial cost of the asset. So borrowing cost is coming to town. So we see provisions, we see borrowing cost coming to town. Not only that, we are also going to be having issues in respect of IAS 20, accounting for government grants and disclosure of government assistance. Why? Because when an entity receives government grants, There are two ways it could be accounted for, either the deferred income approach or the write-off approach. If you are going to be doing the write-off approach, then the initial measurement and recognition of the asset, let me do this, initial measurement and recognition of the asset will be different. And so IAS 20 could come to town, and you got to be mindful of that. Not only that, IAS 21, effects of changes in exchange rates, could come to town. Why? Because transactions that are denominated in a currency other than the functional currency of the reporting entity must be translated into the functional currency of the reporting entity. And so IAS 21, effects of changes in exchange rate, can come to town there in the initial recognition. Now, so when you are doing initial recognition, you see that the connection, and that is how you learn the accounting standards. So it's not that the accounting standards are like islands on their own. They are intertwined. Yes, we must know them independently, but the beauty of the accounting standards is that they are intertwined with each other. And when you study them like that, it increases your ability to understand them very well, and most importantly, put you in the position to go into the exam and pass the examination. On subsequent measurement, IAS 16 states that the entity can apply either the revaluation model or fair value, or carry it at the cost model. Okay. But on subsequent measurement, there are some accounting standards that could also come to town. The first one is certainly IAS 36, impairment of assets, because we have to, on subsequent measurement, we have to test for impairment. Why? Because the standard says that an asset cannot be carried above its recoverable amount. And the recoverable amount of an asset shall be the higher of value in use and then the fair value less cost to sell, or the net realizable value. So IAS 36, it's going to be coming to town here. And remember, it is not just in respect of the impairment of specific property, plant, and equipment. We also have impairment of cash generating unit, which is a whole business suffering an impairment. But we're going to be coming back to that impairment. Not only that, there could be transfers on subsequent measurement. What do we mean? A property, plant, and equipment could be reclassified. The management will decide to sell the property, and the property may be available for sale, and they are looking or located a buyer, and they expect that the sale should be completed in less than 12 months. Okay. In that case, that means we have to derecognize it from PPE to a non-current asset held for sale and discontinued operation, which is IFRS 5, non-current asset held for sale and discontinued operation. Not only that, when we revalue the assets, what's going to be happening is that there may be tax implication on subsequent measurement, because remember, IAS 12 states that an entity must recognize the future tax consequences on all transactions, and PPE, or property, plant, and equipment, is not an exception to that rule. For that reason, IAS 12 is going to be coming to town here, and we must understand it. Because yes, there is IAS 12 standing on its own, we must know it, but also when we revalue assets and there's a revaluation surplus or whatever, the tax implication of that must be accounted for as well in the books, and that is where IAS 12 income tax is going to be coming to town. And so on the subsequent measurement, not only are we dealing with IAS 36, IFRS 5, we're also dealing with IAS 12. Heck, we can also bring in IAS 40, investment property. Why? Because again, the transfer issues that I mentioned can happen here, because we can transfer an investment property into a PPE, or a PPE into an investment property. Hey, an investment property could even be transferred into inventory to be sold in the ordinary course of business of the entity. So you realize that. Now, there are other things I could add, okay? I'm just being a bit conservative here when in the discussion. But you realize that connected with IAS 16 alone are what? 8 other accounting standards. Again, I'm just being conservative here. There are about 3 or 4 more of them that we could bring here because of the connection or the relationship. But that is the idea here. So you are dealing with IAS 16, but it is connected with 8 other accounting standards. So when you learn it like that, when you see it like that, it makes the standards easier because you know, oh, this thing that I'm learning, I will apply it in this standard. So when you do it like that, it makes your brain understand that, hey, you can't forget this thing because you are going to apply it in this, because you're going to see it in another standard. So when you see it in another standard, then it becomes a revision, then you apply it to that standard. I hope you are getting the idea. It becomes a revision, then you apply it to the standard. So that's IAS 16 and the various standards that we need to understand there. Now, in addition to these standards here, connecting with IAS 16, are 3 other standards that, I talk about all the time. IFRS financial instruments, leases, and then IFRS 15 revenue from contract with customers. These 3 accounting standards, we must know about them. Leases, revenue from contract with customers, and then financial instrument. Now, when it comes to financial instrument, there are 3 accounting standards for financial instruments. 3. So we have the IFRS 9, financial instrument recognition and measurement. Then we have IAS 32, financial instrument presentation. We use that to deal with compound or convertible loan notes. So when an entity issues convertible loan notes, then the convertible loan note must be split into the debt component and the equity component in accordance with IAS 32. That is financial instrument presentation. Then you come to IFRS 7, and that is financial instrument disclosure. So when it comes to financial instruments, 3 different accounting standards there. Then we come to leases, IFRS 7. Then we come to IFRS 15, revenue from contract with customers. Now, these 3 are together, and you must know them together like that. Why? Because either the examiner will bring them independently. So we could have question on IFRS 15, revenue from contract with customers, or it could form part of the notes to the preparation of the financial statement, the single entity financial statement. Because an entity could sell something, but performance obligation hadn't been satisfied yet, but it had included the amount in their revenue. If performance obligation hadn't been satisfied, how are you including it in the revenue? Which means they are breaching IFRS 15. So you must come in and reverse the transaction and account for it in a manner that it has to be accounted for. Or the entity makes sales and they have an option to buy back the goods at some time in the future. So if we sold some goods with an option to repurchase at a time in the future, that means the transaction is not a sale, but it's a financial arrangement. So that transaction should not be accounted for in accordance with IFRS 15, revenue from contract with customers, but should be accounted for in accordance with IFRS 9, financial instruments recognition and measurement, because it means we went for a loan and we had used the goods as a collateral facility. So if the entity had included the proceeds in revenue, what do we have to do? We must take it out and rather recognize a loan note, because it's a loan that has been taken from the supposed customer that we sold the goods to. Now, although the goods are with the customer, what it means also is that we would have to recognize the goods as part of the closing stock at the reporting date. Because remember, we hadn't sold the goods. We are using the goods as a collateral facility. So it is still ours and must be included in the closing stock at the reporting date. And that is the beauty of the accounting standards again. So when you are learning IFRS 15 and you are learning IFRS 9, it's not like they are 2 distinct standards. No, they have connection. Then you come to leases, IFRS 16. There is a part in leases where we talk about a sale and leaseback transactions. In a sale and leaseback transaction, the way you treat sale and leaseback depends on whether performance obligation has been satisfied or not in accordance with IFRS 15. Because if performance obligation has been satisfied, then the transaction is a sale. But if performance obligation had not been satisfied, then the transaction is not a sale, but again, a financial arrangement. So, although you are hearing sale and lease back, it will rather be accounted for in accordance with IFRS 9 financial liability. And that's the beauty of the standards. So these three standards also have a lot in common. So when you learn it like this, or you see the accounting standards like this, it becomes beautiful. So you know that, it is not like, you are learning a tall list of things. No, they are connected. They are related. You are going to be applying one principle in another standard. You are going to apply this principle in another standard. And when you study it that way, it put you in the position to go into the exam hall and write the exam with much confidence. Why? Because you understand exactly what you are doing. So you look at IAS 16. 8 accounting standards coming up, making 9 accounting standards just under IAS 16. Then these 3 accounting standards, or maybe 5, financial instrument alone is 3, the connection there. Then the other accounting standards like IAS 2 inventories, IAS 41 agriculture, IAS 8 accounting policies, changes in accounting estimate and errors, IAS 10 events after the reporting period, IAS 33 earnings per share, IAS 24 related party disclosures. These are the accounting standards. And this is pivotal when it comes to passing the financial reporting examination. Your passing or failing of the exam depends on your understanding of the accounting standards. And as I said, don't look at it and say, oh God, when will I finish all of these accounting standards? You gotta know about them. And the beauty of it is what I mentioned here, that they are intertwined. They are related with each other. So it's not like, you learn them and they are on their own and you have to, no, they are connected with each other, and that is the beauty of the accounting standard. And as I mentioned, that is one of the benefits you get in enrolling on our platform, because you have access to key summary videos on all of these accounting standards. Summary videos explaining the fundamental principles on all these accounting standards. In addition to that, you get access to the full lectures with practice questions, right? So once you watch the summary videos, which means that with the summary videos, you can go through everything and finish the syllabus in record time, or finish the accounting standards in record time. So once you understand the principles underlining each of the standards, what do? You now start exposing yourself to questions. Because I say this always. It's not about how many questions you solve. In the exam hall, 99.9% of the time, the questions you will see there, you've never seen them anywhere. 99.9% of the time. So if the questions you see there, you've never seen them anywhere, in the exam hall, what are you doing? Applying principles. So you must know all the basic principles underlining each of the standards and the advanced principles underlining the standards. Why? Let me just show you something. For instance, if you take a standard like IAS 36 that I spoke to you about earlier, impairment of assets. When the carrying value of the asset is greater than the recoverable amount of the asset, it means the asset has suffered an impairment. Good. However, where the carrying amount is less than the recoverable amount, the asset hadn't suffered an impairment, and we will carry it still at the carrying amount. That's okay. But when you're dealing with a cash generating unit, in impairment. Now, this is where the advanced issue is going to come in. When you're dealing with a cash generating unit, which is a business or a segment or a division of a business, you have to calculate the impairment of the cash generating unit. When you finish, you must allocate the impairment. Now, the basic rule is that you write off separately identified impaired assets. So as stated in the question, did some assets suffer an impairment? Yeah, you write it off. Number 2, is there goodwill? Does the cash generating unit has goodwill? If it does, you write it off. If we still have some of the impairments left, then we are going to allocate it among the remaining assets that have not suffered an impairment already. Now, the advanced rule about IAS 36 is that After the allocation of the impairment, an asset cannot be carried below its fair value less cost to sell. So when you finish the allocation, an asset cannot be carried below its fair value less cost to sell. And that is the advanced aspect of IAS 36, impairment of assets. So what you are doing is, you got to understand both the basic principles on each of the standards, and some of the standards have a little advanced understanding that you need. All I'm trying to say is that in order for you to pass your financial reporting examination or corporate reporting examination, you need a deeper understanding of the accounting standards. Because when you understand the accounting standards, that is where you can then put yourself in the position to come and successfully deal with single entity financial statement. Because as I mentioned, each of the footnotes will be an accounting standard that you're going to call on. Evaluation of financial statements, same idea, same principle may be applicable there. And even in consolidated financial statements, same idea, same principle will be applicable. And so one thing you must understand is that you have to be solid on the accounting standards. And that is why I want you to leverage the key summary videos in the mobile application. Download them. Watch them over and over again. Have a summary note on all the standards. If it is a diary, have a diary. If it is a notepad, have a notepad. And this is separately just for the accounting standards. And you have all your principles. So when you are solving a question and you are reading something in the question and you are not understanding, or you solve the question and you get it wrong, and you are looking at the solution and you've done something you don't understand, what do? You come back to the principle and find out, which principle are they applying here? Because in the exam hall, all you are doing is applying principles. That's all you are doing in the exam hall. You are applying principles, period. So once you get your accounting standards right, it means single entity financial statement, you will succeed there in that case. Then certainly the last thing will be, the last bad one will be financial statement evaluation or evaluation of financial statement. That's a 20 marks area coming in the exam hall. Give me a sec. Let me see if I can probably bring this up. Yeah, I could bring it up. So when it comes to ratios analysis, there are 6 types of questions the examiner can bring. One of them will be in the exam hall all the time. Now, this is corporate reporting 6 times, 6 types of questions. For financial reporting students, we just have 4 types of questions you need to understand. The first one is where the examiner presents you with a simple financial statement. Okay, simple set of financial statements. And you're just calculating ratios and analyze. Simple. No problem. No giddy, nothing serious, nothing intimidating. Very sweet, simple, straight to the point. You are just calculating ratios and analyzing the ratios. That's all. The second type of question is where the examiner will just ask you to write the analysis in the exam hall. So here you are not calculating any ratios. The examiner has already done the calculation. What you're doing is analyzing the ratios. Number 3 is the vertical or the common size analysis. So this is where either you will be required to prepare a common size statement, or the examiner will present you with a common size statement and you are going to analyze the common size statement. The common size statement is simply where the original financial statement is represented in percentages. So when it comes to the common size income statement, total revenue is used as the basis. What it means is that each of the line item in the P&L account is expressed as a percentage of the total revenue. For statement of financial position, common size statement of financial position, the total asset is used as the base. So each line item in the statement of financial position is expressed as a percentage of the total asset. And that's the third type of question the examiner can hit you with. The fourth type of question is where there is changes in businesses or changes in the operations of the entity. Either in the current year, the entity is disposing part of the business, or in the current year, the entity has acquired another business. The way you calculate the ratios and do the interpretation of the ratios will be different from the way you deal with normal ratios. Then certainly number 5, financial statement with footnotes for adjustment. So here you are going to apply the standards so that you recalculate or re-prepare the financial statement, then you calculate the ratios, then you evaluate the performance of the entity. So you are doing 3 things in the 5th type of question. Then consolidated cash flow analysis. This is exclusive to the corporate reporting students. This is exclusive to the corporate reporting student. Financial reporting, the examiner will not ask you for, consolidated cash flow statement analysis, but this is for corporate reporting students. So when it comes to that evaluation of financial statement aspect, that 20 marks area that the examiner is going to be bringing, there are some theories there, limitations of ratio analysis, and then importance or objectives of ratio analysis. In addition to these 2 theories, you must know about each of these types of ratio questions, the principles underlining how you approach such questions and how you do the analysis. And we have this analysis guiding principle available, which you are going to be getting access to certainly in the main class when we are discussing this in detail. We have the analysis guideline available and all of the types of questions, the way you approach them. And these are the things you must understand when it comes to the evaluation of financial statements. Then suddenly we come to the last one, which is consolidated financial statements. 20 marks area, question 1, waiting for us in the exam hall. Consolidated financial statement. Very important topic that we must know about. Now, here, there are a number of things that you need to be aware of. There are some standards here. So in addition to all of those standards that we've spoken about, there are some other standards here that you must be mindful of, like IFRS 11, joint venture arrangement. Okay, we have IAS 28, and that is investment in associates. We have IFRS 3, business combination. And then we have IAS 27, separate and consolidated financial statement. Okay, so in addition to the other accounting standards that you must be aware of, that you must know about when it comes to the preparation and presentation of financial statements, all of those accounting standards that we spoke about here, in addition to these guys, when you get to consolidated financial statement, you must know about these 4 guys as well. And again, on our portal, we have the consolidation masterclass video available. So we have the consolidated masterclass videos available, going through all of these things and the various concepts that you must understand when it comes to consolidated financial statement. Why? Because you must understand the basic principles about consolidation. Again, in the exam hall, all you are doing is applying principles. So when you read the footnote, you should be able to know how to undertake the key workings based on the context of the question. How do you get your group structure? Okay, because the group structure will help you to know the post-acquisition period. If you miss the post-acquisition period, you're going to be losing a lot of calculations when it comes to consolidated financial statement. And so we must understand the post-acquisition period from the group structure. We must know how to calculate goodwill. Whether I like it or not, you are going to be calculating goodwill when it comes to consolidated financial statement, either goodwill at acquisition or goodwill at the reporting date. You must know how to calculate the goodwill and apply the principles. Not only that, you must know how to deal with non-controlling interest if we don't have 100% ownership of the business. Okay, so non-controlling interest, if we don't have 100% ownership of the business, you must know about that. So group structure, so you know about post-acquisition period, goodwill, non-controlling interest, dealing with intra-group trading, Okay? This is pivotal to your ability to pass the examination. Intragroup trading. So if they sell goods among themselves or between themselves, how do you account for that? If they sell assets, how do we account for that? If they issue loan, how do we account for that? The key thing is that all intragroup transactions must be eliminated on consolidation. So how do we deal with that? The basic principles about intragroup trading, you must know about it. Then certainly the calculation of the post-acquisition profit or loss. And then if there is an investment in associate, how do we account for investment in associate using the equity accounting in accordance with IAS 28, investment in associate. All right. So these are the things that you must understand again when it comes to consolidated financial statement. So in the financial reporting class, this is the breakdown of the syllabus and the various things that you must understand under each of the breakdowns. Again, why is this important? Because once you know, okay, this is the breakdown, this is what I'm expected to know about, it helps you to then put yourself in the position to prepare your study plan, know what you have to do, and then go through them with the videos available in the mobile application as well as on the website. Go through the videos and as well as joining the live lectures, doing assignments, involving yourself in a performance evaluation test and all that, and that will position you to be able to pass the examination.